Obviously, as we continue to kind of get into, this big week of earnings season after the bell today, lots of big tech companies coming out to report their earnings. That'll obviously have an impact on markets as we kind of wind up this week. But going into next week, those number of earnings start to run off, and there's a lot of other kind of economic news that's now starting to show signs of weakness. In fact, I wanted to go through a few of those things this morning with you that have kind of really popped up on the radar, and something to be thinking about here now as we get into August and September. As we've talked about here recently, August and September are probably going to be tougher months for both the economy as well as for the financial markets, as really kind of these two start to collide in the next couple of months. The first thing is, as we look at this, is that this is the Phillips Curve, basically, which compares the employment population ratio and inflation relative to Fed funds rate. So the question is when is the Federal Reserve actually going to raise interest rates? The answer is actually never, because if the Fed raises interest rates, and we saw this during 2009, 10, 11, 12, 13, 14, interest rates remain near zero, even though we had population growth, even though we had employment growth, even though we had some minor forms of inflation. They kept interest rates at an extremely low level, and we barely got any economic growth at all. We were basically running at what is considered to be escape velocity. On an inflation-adjusted basis, we're running right about 2%. You've got to be above 2% economic growth on an inflation-adjusted basis to absorb population growth, and we really never got much above that. So the reality is that most likely over the course of the next decade, there's going to be very little incentive here for the Fed to actually raise interest rates. And this really comes at a time where we're talking about a $5 trillion deficit ultimately when we get through more bailouts, and the fact that we're carrying almost $75 trillion in total debt. You simply cannot raise rates in that environment. Talking on the employment front, though, since we're talking about employment here, it's interesting when you take a look at how many people are now unemployed, receiving no pay, and not retired. That number is now 62 million people, and that is actually down from 65 million people back in May of this year. But we are not seeing a real recovery here. While we see employment numbers come up that say, hey, we hired 2.5 million people, we hired 3 million people, etc., there are still a large number of individuals that are unemployed without pay, and that number has actually been rising over the last couple of weeks. So employment numbers are probably going to be weaker over the next couple of months, because we're already starting to see the impact of companies starting to reverse reopening, starting to slow down hiring, etc. Also, here you can really take a look at this a little bit better. This is the Household Pulse Survey, and this was from Ms. Shedlock this morning. The number of employed has actually dropped here from 134 million to 130 million. So about 4 million people have now come off the rolls again. Now, if you've ever been wondering about what is the difference between the unemployment benefit claims and what these enhanced benefits are, the $600 a week, this is what it looks like. Going back to 2000, this lower line here is the $291 per claimant per week, and that was the average back in 2018. This is the current $809 a week that people, this is that extra $600 check that people are getting right now. And when you want to ask yourself the question why people aren't going back to work, here's the answer. So when you're making this much more money, you're making more money now than you were actually working. So, because remember, this is the actual unemployment benefit claim is based on your previous income. So when you're seeing this big of a jump, this is why there's been a lot of concern over people not going back to work. They're receiving more benefits. This is why you're seeing, retail sales actually doing very well, because people are getting a lot of extra money here. Now, that's the good news. The bad news is all those benefits just ran out today, because we haven't passed any type of extension here on the bill, and those unemployment benefits actually ended today. And the big question for the White House is going to be, what do they do here? The bill between the House and the Senate has now stalled. There's no progress on that right now. President Trump's talking about maybe doing a short-term extension with what he can do on an executive order basis, but until they get something figured out here, there's potential risk to the economy and to the markets, potentially short-term, as that extra $600 a week. Now, that's $2,400 a month that goes away. Back to the markets here real quick. The last time that we saw as much options activity as we see right now actually in the tech sector, these big names that are reporting after the bell today, was back in January of this year. I'm not saying anything, but when you get this much exuberance, so to speak, within a particular area of the market, those tend to be kind of peaks in the markets. And this is why we talked about 3 weeks ago. We said, hey, we're trimming our tech exposure here a little bit, reducing some of our gain, taking some of our gains off the table. Big runs there, lots of exuberance here in this sector. So again, there's a real big potential here, even with earnings coming out tonight, that there could be some disappointment in performance tomorrow. And so we'll take a little bit of attention to that. Also, I've talked about before about earnings season, talking about earnings. Earnings season is millennial soccer, right? We lower the rate, the earnings levels low enough, and then all of a sudden, all these companies beat. And this is why you always get a 70% beat rate. Well, look at this, 85% beat rate, because we lowered estimates so much going into this earnings season. All the companies are beating. Now, they're beating much lowered estimates, right? So, it's not that they're actually making more money and they're being more profitable, etc. Actually, when you take a look at the makeup, it's primarily the top big 5 mega cap names right now, the ones that are driving the NASDAQ market, that are making up about 80% of earnings and sales for the whole index itself. So, really the actual density of earnings and the real profitability of these companies has fallen markedly. But yes, if you take the hurdle and you lay it on the ground, it's really easy for people to get over it. And that's what you're seeing here as we go through this. So last thing here is we talked about earlier this week that we've begun taking on a little bit of long dollar exposure here. We trimmed back on our international. We also reduced our gold exposure. Oh my gosh, that's heresy right now in the markets. But our good friends over at Sentiment Trader did a good analysis on this morning, which actually confirmed why we've talked about this earlier this week. But any time that dollar exposure has been this negative, basically over every time frame going forward, gold has not performed well over the course of the next year. So again, here's gold going up at a peak, and at a time when it's combined with very, very low dollar exposure. In other words, everybody's bearish on the dollar. Where we are right now, that has been actually a peak in gold prices. So it doesn't mean today or tomorrow, but when you have this much of a negative pressure on any asset class, and people, and when you start seeing it on every media outlet, CNBC, Fox News, everybody's talking about the dollar going down, we're about to lose reserve currency status, that's typically at least a short-term bottom in the dollar. So that's why we add a little bit of dollar exposure to our portfolios, reduce some of our risk there, and again begin to really kind of base ourselves for a bit of a reflexive rally in the market. So, all right, quick break. We're going to come back. I'm your host, Lance Roberts. We're going to pick up with Michael Lebowitz, talk all about Fed and what did they say yesterday, what didn't they say, and what does it all mean. That's coming up next right here on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Welcome back to the show. I'm your host, Lance Roberts. So Mike and I are just talking off air here for a second. Some of the best conversations happen when we're not on the air. So we're talking about the election coming up. Mike says he's going to vote for his mom because if his mom wins, he gets to be Secretary of the Treasury. So I like this. This is a career path I can get behind.
and Lance,
yes.
Lance becomes Director of the Fed, Chairman of the Fed. And Brent, if you play your cards right, I could see Director of Communications.
I can do that.
Yeah, so you could be the White House spokesperson.
That's right.
There you go.
I don't know. Brent is actually as much qualified as Larry Kudlow to be the National Economic Advisor. So I think maybe we'll put Brent in charge of the economy.
A left-handed compliment?
Yeah, that didn't really actually come out the way I intended.
Not quite sure how to take that.
I meant to try to slam Kudlow, but I think I actually got you instead. It kind of
Thanks a lot.
kind of a splash back on you. So anyway, all right, let's talk about the Federal Reserve. Yesterday, Jerome Powell announced that shockingly, they are not raising rates and that they stand ready with all of their tools and they're ready to do more if necessary.
But interestingly enough, if you take a look at the programs that they've already done, right, at this point, so the corporate bond purchase program, the Main Street lending programs, the PPP, all these programs that they're into, the uptake of these programs have not been terrific. There's still a lot of room available in these programs that has not been utilized yet by these various facilities. And it's interesting because the demand, despite what we hear, that the economy is in these dire shambles and the world's come to an end, so to speak. You would expect these programs, there should have been a massive tidal wave of demand for these programs, but there really hasn't. So, I mean, how do you kind of explain that dichotomy?
So I think what's going on, and again, I'm going to bring up my brother. We'll update everyone on my brother. And he owns a printing press, and we've talked about him a couple times. And he was basically going into bankruptcy in March and April because he does printing, marketing, all the junk mail, at least in the Washington area. All the
he's
junk
my favorite guy.
All the junk mail you get from real estate agents is coming from him.
All right.
So that's him. So in March and April, he was doing next to nothing. But then the suburban housing market really picked up. And he also fired a lot of people. He took a PPP loan. And now I can't talk to him. He's so busy. He's running around with his head chopped off because he has so much business now. It was one of his best Junes ever. So in that case, PPP really served its purpose. It got him over that chasm. He held on to a decent number of employees, and now he's up and running and doing good business. But there's a lot of people, the restaurants are a great example. They're struggling mightily still, and they took the PPP loan. They kept people on staff, but for no purpose. And now I think they're looking at it and say, well, why do I can't, it has nothing to do with the money being available. There's no business here for me to do. Mm-hmm. And I think that's the problem, is that the people like my brother don't need another loan. And then you got a whole group in the other camp that say, I'll take the money, but I got nothing to do with it. I don't have an underlying business.
Right. And that's very true. When we look at the number of small businesses that are either close to filing for bankruptcy or have filed for bankruptcy, it's an alarmingly high percentage of businesses that have now failed. And, this is one of the things that we kind of continue to work through is really, do these trillions of dollars that we're throwing at the economy, we're trying to solve a problem that was we had a demand problem to start with. I mean, the economy was only growing at about 2% even going into this. And we were talking last year, the inverted yield curve was already signaling there was economic trouble. The pandemic was just the trigger that caused this, this bubble in the economy to pop, so to speak. And, we're throwing money at it, trying to fix it, but you're not fixing the underlying problem, which was there was too much debt, not enough demand. And now we've kind of exacerbated that problem even more because we're not allowing the system to correct itself.
Right. And we've made the problem worse in the future. Our economic growth, we've talked about this, will be much slower in the future because now we have to service all this debt. And instead of investing in things or buying things, whatever we want to do with that money, it's got to just pay off debt. And that's again, we're going to have slower growth, and the Fed is just going to have to keep their foot on the pedal for eternity.
Yeah. Well, and that's the whole point. And so, when you listen to what Jerome Powell said yesterday, again, really nothing surprising here because really what other choice did he have? If he can't really come out and say, look, we've got a valuation problem in the market. We've got distortions occurring in, asset markets that are dangerous to the overall economy. He can't address any of these issues because it would actually create the exact effect that he doesn't want. You cause a big panic in stock prices fall, that impacts the economy, reduces confidence. So pretty much he's trapped into where he is now and really has no choice to try to normalize their policy relative to the economy to actually create some organic growth down the road.
Which is funny because it's really a bad circular loop. Mm-hmm. He's trying to get policy for the economy, but at the same time, they're hurting the economy, and then they're providing more policy to hurt the economy. And he's just creating this horrendous feedback loop that's going to end with a natural growth rate of zero.
Right. Well, yeah, we've seen this in other countries as well. I mean, we're following the exact same path that Japan has tried, and the comments always come out and says, well, Japan is they've done all this, and they're not dead yet. They're close, but yeah, they're not dead
Japan
yet.
has the same GDP today as they had in the late 90s.
Exactly, and that's the problem with this. But we're trying to solve short-term problems without understanding the long-term consequences. Instead of look, this is terrible to say, right? That we would have to hurt people, but you've got to some point, you've got to make that decision to allow companies to fail. You've got to allow people to, file for bankruptcy and do these type of things so that they can resolve themselves of the debt. And then importantly, like we were talking about the CMBS just a second ago, the commercial mortgage-backed security market that Congress now wants to bail out. At some point, you have got to let investors take the damage for the risk that they took. They took risk in the stock market. They took risk in the bond market. They knew what the risks were going in. At some point, you've got to let them take kind of quote unquote take their lumps, because you've got to resolve that debt issue. But we won't do that because we're so afraid of hurting Wall Street or the individual person or whatever it is. We got to keep propping all these things up. But the long-term damage is potentially it's death by 1,000 cuts, right? It's a long-term slow torture that gets you to the same position. It's just going to take longer to get there.
Right. And at the same time, and we just wrote about it, is you're destroying the capital markets, which is one of the main arteries, lifelines for capitalism. Right. If you like, one of our examples was corporate bond spreads. Mm-hmm. So when we say corporate bond spreads, we say it's basically the difference between the yield on a corporate bond versus the yield on a quote unquote risk-free treasury. And when things are good, the economy's running, companies are doing well, that spread is small, it's tight, because investors don't need much to be compensated for the risk they're taking. And conversely, as you kind of approach recessions and during recessions, the spread widens out because investors want to be compensated for potential losses, but loss of earnings, that type of thing. And that has, if you go back through history, that's what happens with corporate bond spreads. They widen out, or they get bigger during recessions. And when things are good, they get tighter. Well, if you look at them this time, they're just about as tight as they've ever been, yet we're in an economic recession, maybe a depression, where we couldn't be more certain about the future. And, we wrote something to the effect that bond yield spreads are about as certain about the future as they can be, while the economy is and people are completely uncertain about the future. And that's just a divergence like we've never seen, but it sends the wrong signals to the market, to the economy.
All right, we'll come back from the break. We'll wrap up, talk a little bit about where we are in the markets, a little bit about gold and the dollar, and also an update on this hurricane. Is it Isaias? Is that how you pronounce it?
I don't know where they come up with these names. Like, what happened to Joe or Tom or Bill?
Okay, first of all, hurricanes are always named after females.
Okay, what happened to Josephine and Thomasina and Billy?
But yeah, interesting story. I actually have a relative that's trapped, and we'll talk about that when we come back after the break.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com. Everybody get up!
So, welcome back this morning. I'm your host, Lance Roberts. So, I just realized this a moment ago as we were getting ready to wrap up the last segment. I happened to glance up, and they have a hurricane tracking chart of this hurricane ICA, however you pronounce it, Isaias? It's three syllable.
It's crazy.
Okay, if you drop the A, it's ISIS. Okay, so that's where we are with this thing.
Hurricane ISIS.
So So it's coming up, and it's heading right through kind of the Cayman Islands, right?
Yeah.
So, and one of the islands that's right in its path is Turks and Caicos.
Yes.
Which I've talked about this before. My family and I we used to go there a couple of years ago, pretty regularly to dive. We haven't got a chance to go back in the last year or so, but we like to go there and dive. It's beautiful, and fish, do some stuff. But my wife was telling me day before yesterday that her brother, who lives in Austin, he's weird. Just saying. He can hang
Keep
out
it
with,
weird.
He can hang out with Joe Rogan coming up here pretty quick. But he took his family over to Turks and Caicos. So this was it was earlier this week, right? I think it was on Monday. They left and they went to Turks and Caicos, and they were going to have vacation there, get ready to wrap up. So they get to Turks and Caicos, and Turks and Caicos says, "Welcome to Turks and Caicos. You're in quarantine for 14 days before we'll allow you out on our island. There's government housing. We'll put you in that for 14 days, and you have to pay for it, by the way. You have to pay for your housing while you're locked up in quarantine. And once you get through quarantine, you're welcome to enjoy the island of Turks and Caicos." He's there in quarantine. The hurricane is headed directly to him. So I don't know how this is going to work out. I don't know if they're going to let him out of quarantine to send him back home.
The Roberts family vacation curse.
No.
continues.
He's not a Roberts.
He's your wife's.
He's my brother-in-law. He's not a Roberts.
It extends. It extends.
All right. So he's weird.
You can't make those things up.
No, I can't, you can't. But I don't know what's going to happen now, but he's locked up in quarantine. and I mean, if they let him out, will he infect the hurricane? I mean, that's the other problem. So,
And then it'll spread all over Florida.
Exactly.
That's a big problem.
He may not be allowed to come back home.
I know. He may not be able to. This is going to be the question. So
Wow.
we'll see
And
what
then
happens.
he'll be in quarantine here once he gets home.
So
Yes, he will.
If I could pronounce the name of the hurricane, I would. But I say yes, or it's ISIS. Come on, let's just go with it. All right. I think that's what somebody came up with is like Hurricane ISIS. And there was, we can't say that. Stick an A in the middle of it. Make up a new word. We do it all the time anyway now. We just make up new words for websites. Anyway. All right, Mike, back to reality here for a second. A couple of things that are going on with the markets. This week is the big peak in kind of the S&P earnings announcements. Tech stocks are all going to announce after the bell today. Earnings are beating estimates, not surprising because we lowered them so much. But one of the interesting things that, we've touched on is what's happening with the dollar and what's happening with gold. Big spike in gold here recently. And my concern is when you start hearing about it on CNBC, 12 hours a day about the price of gold, it's probably time to take some money out of the position and maybe kind of rethink the position, at least temporarily. Same thing goes with the dollar. Pretty much all day long on the media channels, it's the demise of the dollar's going lower. As soon as the Fed made their announcement yesterday is that, the Fed announcement drives the dollar even lower. I mean, everybody's got this focus on the dollar. We're about to lose reserve currency status. But we're actually building a long position in the dollar right now because of this extreme. Yep. Right.
And look, I'm our resident gold bug. Sort of.
Yeah.
And a few days ago, we, I brought up selling a little bit of our gold, taking some profits because, like you said, Lance, it's been tied to the dollar. Mm-hmm. But so has stocks and bonds, and everything has been tied to the dollar. So what we have to consider is the dollar is just not the dollar on its own. It's the dollar euro, the dollar yen, the dollar index, which is against a basket of currencies. Mm-hmm. And so let's just think about dollar euro, because that's one of the more important crosses. The euro is starting to bump up against some significant levels. The euro region has deflationary problems. The stronger the euro gets, the more deflation they start importing. Mm-hmm. So the question is not necessarily how weak can the dollar get, is how much further will the Europeans allow the euro to rise? And then you can extract that question around the world. You got the same thing with the Chinese yuan. Mm-hmm. It's starting to hit some major support too on the upside. The yen has been really strong. So it's a question of the dollar and how weak are we letting going to let it go, and that's inflationary, which is what the Fed wants. But it's the exact opposite for every other country. And what we're seeing now is not unprecedented, but the correlation or the negative correlation between the dollar and all these asset classes all at once, stocks, bonds, gold, commodities, you name it, are all the correlation is very high.
Right.
So it feels like something is getting ready to snap, because it's not just one market, one sector. It's so many different things.
Right. Well, and again, it's and the other thing too is just remember is that nothing moves in one direction, and the extension. You've got such negative sentiment on the dollar. You've got such bullish sentiment on gold. You got extremely bullish sentiment on stocks. It doesn't matter what commodities. You've got you take a look at a chart of copper or lumber. Type of thing. They've just gone vertically. They've gone parabolic, kind of in a vertical spike. And those things never last long historically, and you're going to have a retracement. I'm not, and just to be clear, we're not saying that the dollar's about to rally to all-time highs, and this is going to be the change dynamic. We're simply saying that we're probably going to get a reflexive bounce in the dollar that will allow us to buy our gold position back cheaper than it is now. And I shouldn't say buy back. All we did was trim it. We still own gold, but we'll add more to our position on a pullback in that. We'll buy back into the international markets potentially. We took that trade off the table as well, because that's impacted by the value of the dollar as well. So, we're all we're doing is repositioning risk in our portfolios. But whenever you get these extremes, this is the time that people tend to make investment mistakes by going, oh, I got to go buy gold. I can't tell you how many emails I've gotten just in the last week about, is now the time to buy gold? No, the time to buy gold was, a year and a half ago when we were buying gold into our portfolios, when it was first showing some signs of life after 3 years of doing nothing. That was the time to buy gold. Now is the time to start thinking about taking gold off the table. But, this is the historical tendency of investors, and why investors wind up losing money over time, because they buy the most at the top and the least at the bottom. As Bob Farrell I used to say.
It kind of feels like a Kodak moment, right? What do you buy Kodak today? No, the time to buy Kodak was 20 minutes before they got that loan from the government.
Exactly. And if you'd only known, like the CEO of Kodak knew.
Unlike Kodak, we are allowed to know some information, right? And we do see all these markets and the way they react together. So, keep a close eye on the dollar index, keep a close eye on these other markets, and you're going to watch. Look, Lance, too, the other side is the dollar could really break down from here, too.
Right.
The trend could just get it, just keep going, which then poses a lot of problems for the rest of the world, but also the United States. So, there's a number of things that can happen, and we're not saying it's, the dollar may just consolidate for 6 months and go nowhere, or may bounce, and then probe new lows.
Right.
But it feels like something's getting ready to kind of snap across all markets. And it doesn't mean it's bad or good. It just, it's something to consider and risk appropriately.
Well, and this is also a nightmare for Jerome Powell, going back to the Fed here for a second, because a big collapse in the dollar at this point would really put a big impact on their capability to do more things, like more QE, more of this, more of that, because of the relative inflationary pressures that would come from a collapse in the dollar. And plus, a weak dollar is not good for the economy, right? We always, even President Trump, when he was elected, he's like, hey, we need to get our dollar stronger. We need to bring stuff back to America and be great again. A stronger dollar is better for the economy than a weaker dollar. So this is potentially, everybody's asking, everybody kind of believes that no matter what happens, the Fed can control the markets. But what the Fed can't control is their ability to support markets if something gets out of control. And that would be a collapsing dollar, a big spike in inflation. And that's kind of what, and to your point, that's kind of where we are. So either we better start manipulating currency here soon, or the Fed's going to have a problem.
Well, what's interesting is a day or two ago, the Fed came out and said that they're going to renew the foreign currency swaps out till March of 2021.
Right.
So the foreign currency swaps basically allow a foreign central bank, instead of going to the market and buying dollars, which would push up the price of dollar, going to the Fed. So I'm just wondering if the Fed is a little concerned that the dollar is going to snap back pretty strongly, and which will then create demand from all these foreign central banks for dollars and become a positive feedback loop for the dollar. So they went ahead now and extended those programs so that if the dollar really comes back strongly and quickly, and remember in March it was up 10 points, which for a currency is a lot,
right?
In a matter of 2 weeks. So I just wonder if Chairman Powell is kind of trying to stay ahead of that one.
It wouldn't surprise me at all. All right, so as we get ready to kind of close up the shop for the day for this Thursday edition, any quick closing thoughts, Mike, on what we should be looking out for here?
Just, again, it's not just one market, it's all markets. Keep an eye on the dollar, keep an eye on yields, keep an eye on gold, keep an eye on stocks, because they're all traveling in the same direction.
So as long as nobody gets out of the car, we're okay.
Bingo.
And that's
no
the
rest
hope.
stops.
That's the hope anyway. All right. So after the bell today, lots of big earnings come out from the big tech companies. That is probably going to set the tone for the markets tomorrow for certain. But also too, just kind of keep a watch, as Mike said, on kind of where things are. Everybody's very, very bullish right now in markets. We took a look at our positioning gauges last week on the show. Those are all pushing up into kind of the greed section of the analysis. So, we're back to that point to where markets are very extended. Option traction on tech stocks is at all-time highs. Last time we saw that was back in January of this year, and you know what happens next. And remember, it's not about what the ultimate catalyst is for the downturn in the markets. It's always something that we don't expect. It's something that's exogenous. It's something that the markets aren't predicting, like the pandemic in March. But what we have is we have all the ingredients for a very sharp correction in the markets because of all the exuberance. All you need ultimately is some exogenous trigger to cause it to happen. What that's going to be, nobody knows, and we never know what it is until it happens. But that's why you want to be alert, manage your risk a bit. That's what Mike and I were just talking about. Take some exposure off the table, raise a little bit of cash, position yourself potentially for something that could happen in the next month or two, which historically kind of aligns with August and September, which tend to be seasonally weak anyway. So get by our website, get our latest newsletter, our updates, our Technically Speaking post, Mike's article out yesterday on the Fed, all on the website now, realinvestmentadvice.com, and check out our subscriber service, riapro.net. Check out our portfolios and more, realinvestmentadvice.com. Have a great day. Chris Salcedo is coming right up.
It's a rich man's world.